So great. Hi, everyone. It's really great to be here. And thanks so much for joining us today on CryptoFest. Good evening if you're tuning in from Asia, and good morning to everyone tuning in from North America. My name is Leslie Lam. I'm CMO at CoinFlex, which is a crypto futures exchange that's building the home of crypto yield. I'll be moderating this panel, or I guess in this case, one-on-one conversation today about the rising tide of institutional investment. Where are we and where are we headed? And so with me today is the great, wonderful, super smart Michael Wu. And so I guess before we dive into the discussion today, let's go ahead and learn more about him. So Michael, can you tell us a bit about your current role over at Amber Group, a little bit about the company, and also the problem that you're solving for the institutional space?
Sure. Thank you, Leslie. Hi, everyone. I'm Michael Wu, the co-founder and the CEO of Amber Group. Amber Group is a leading global digital asset platform. We help everyone from the largest billion-dollar institutions, family offices, to global consumers in all their crypto finance needs. Everything from buying and selling cryptos against fiat or against other cryptos, to trade executions, earning yields on your crypto and stable coins, constructing a portfolio of digital assets, borrowing, lending, making payments with crypto-empowered technologies, structured products, derivatives, you name it. And when it comes to institutional services, that's actually our bread and butter at Amber Group. We started the company initially servicing exclusively the institutions, the institutional customers. And due to our background, the company was originally founded by 5 Morgan Stanley traders and a Bloomberg senior system engineer. So even in our previous career, we were either servicing these large institutions and family offices, or in our CTO's case, building systems like EMSX and TraderBook that's used by all these institutions when they trade bonds or equities. So now we migrated that experience, of course, over the past 4 years to offer what we think is really one-stop prime services for all these institutions.
Great. So really an all-in-one platform, servicing everything from trading to asset management, financing, right? And then so we'll get to that, in just a little bit, talking about the bundling of services, making it easier to service the institutional space, who, quite frankly, are oftentimes overwhelmed just when they have to learn about how to get started, right? So the one question on many people's minds right now is, what is the state of global institutional capital getting into crypto? And with the launch of the Bitcoin ETFs in the US in recent weeks, we are seeing institutions getting interested in crypto exposure through traditional financial products. But, this has been a long time coming, right? We've seen lots of building in the space, and we've needed that in order for the crypto market to grow into the $2.7 trillion market cap that it commands today, right? So to this end, we've seen tools and infrastructure being built around the user needs. And to use a great line that I read in a report by Consensus recently, you can map out these user needs according to the capital allocation cycle, from research to pre-trade compliance, to best execution, right? Monitoring, reporting, and custody, this whole capital allocation cycle. All right, great. I see our panelists have joined us. We have not gotten into the first questions yet, so great that everyone is here. Let's start with Dean. We can go over to Markus and Felix next. Why don't you give a brief introduction about yourself, the company that you're with, and the problem that you're solving for the institutional space.
Yeah, sure. Apologies earlier. I was too eager to see you and Michael clearly, so sorry for popping in for 2 seconds.
Oh, good.
Dean Thomas. I run institutional capital for Polygon. I think the simple thesis is that, right now our current market is $2.5 trillion, plus or minus. It's less than 1% of global asset base. The question I always ask is, what is the space going to look like when that number goes to 1%, 5%, 20%, right? So who's going to absorb that? Which projects are going to absorb that? And so my job is mainly being the interface between us, Wall Street, and the major institutions. And so as you might have seen with the Bitwise launch and the Osprey launch, and we have about 4 or 5 other vehicles coming online, we want to create the vehicles to allow the massive, like $9-10 trillion asset managers to have access to Polygon. And so it's been very exciting, 24/7, but excited to be part of the panel. Thank you for having me.
Cool. Yeah, and thanks for having me here. My name is Markus. I'm working on Cello at C Labs. I'm an economist, so I work on everything economics related on Celo. On Cello, we built a mobile-first blockchain that creates a more inclusive financial system and want to make large-scale crypto usage available for everyone and basically also for real payments. I think in terms of the institutional space, we've seen first institutions using Cello blockchain. For example, here in Europe, we saw Deutsche Telekom, the parent company of T-Mobile, purchasing Cello token and announcing a strategic partnership because they see also Cello as a mobile-first blockchain being a good fit for what they would like to do. They have a lot of real users, 242 million mobile users, for example. And that is a nice example how institutionals are coming into the blockchain space. There are others also, and happy to chat with the panelists here in this event.
Great. Felix?
Awesome. Hey guys, my name is Felix Hartmann, and I am the managing partner of Hartmann Capital. We're one of the first actively managed crypto asset managers. Back in 2018, we opened our first product, which does regular crypto asset management, meaning what institutionals usually can get access to generally is indexes, right? But the problem with indexes is that they're usually lagging innovation. So what they're allocating to, for example, most indexes until 2020 were pretty much Bitcoin and ETH. That's it. So if institutionals want to get exposure to DeFi, they simply couldn't unless they work with an active manager like ourselves, where they get exposure to things like DeFi, yield farming, and so forth. And actually, we launched our second fund now, which is in the Metaverse space. And I think we're one of the first 3 Metaverse funds in the world because even yesterday, Mark Zuckerberg announced that they're rebranding Facebook to Meta, right? So there's a lot of people out there in the institutional space that say, I want to allocate to this thing called the Metaverse, whatever it is, right? And there's only so many venues to do that because it's going to take quite a long time to develop these more mechanical instruments like indexes and ETFs that will, like the first Metaverse, index will likely not be out until, 2 years from now. So active managers like ourselves can help institutions get access early on.
Great. Well, right before we had the whole crew here join, we posed this question to the audience, right? Which is, what is the state of global institutional capital that's getting into crypto right now? So that's kind of the overarching thesis. But Michael, would love to start with you and get your thoughts on what has improved over the past couple of years to be able to attract and enable institutional finance to come into the space, and you can feel free to touch on points such as regulation, infrastructure, product set, whichever you think is more important in your view.
Sure. Thank you for the question, Leslie. I think, a lot has improved over the past 4 or 5 years for crypto to become a asset class that institutions can actually enter, can allocate, and can do more about. I think, if you look back just 4 or 5 years ago, right, when the ICO boom first started, for institutions, maybe with the exception of Bitcoin, it was very difficult to participate, right? They don't have the mandate, they need to amend, all their documents. They need to figure out, all the compliance system and all of that to even have a simple position in Bitcoin, not to mention other altcoins, right? And also, at the same time, a lot of the activities back then was focusing more on the primary markets. So VC investors were actually, one of the first who, had access and, has some mandate to even invest in crypto. Now, things have clearly changed over the past 4 years. Now, there are Bitcoin ETFs, the CME Bitcoin futures actually has, quite significant volume nowadays. So a lot of institutions finding trading Bitcoin no longer an issue, right? But over those 4 years, right, they also started to actually work with, crypto native institutions such as the Amber Group to have, the real crypto underlying asset on the book, and figuring out, all the bookkeeping, all the trade booking, all the reconciliation around that. Now, broadening the asset class, a lot of them now have positions in other crypto assets other than Bitcoin, right? They started to have position in Ethereum, in other tokens, or even in assets that are, moving from the traditional space onto the blockchain space. So, but to do so, right, and again, we are talking about many more types of institutions now. Now it's no longer just the VC guys or some of the more adventurous or flexible macro players, right? You now have even the most conservative players or the most long-term players, the pensions, the endowments start to actually have exposure to crypto. But we're still a long way to go. Right now, if you look at the space, right, for anything from simple trading infrastructure, there are a lot to be improved, to sort of investor education. And you have to understand, for institutions, the investor education has to go one layer beyond. You can't just convince the fund manager. The fund manager has to convince their LPs or their investment board, and therefore they're ultimately responsible for their investors and have to convince them as well, right? So I think a lot of things are still being built. As the guys on this panel mentioned, everyone is working towards the same vision to make a crypto even more accessible to not only institutions but also to everyone.
Great.
Sure. So I think, first of all, I'm a big fan of Michael's business, Amber. I've worked closely with TT. They've done excellent. I think we're seeing a lot of professionalism, like Michael's company, for example. Like beforehand, if you were doing stuff in 2018, 2019, there's just a lot of crypto DGen native folks, which is great, right? It's the community we grew up in. It's the community we love, the Pepe memes, everything that we love about it, right? But the thing is, as we want to invite institutions into the space, we need to have a level of professionalism that makes the massive fund managers and LPs comfortable putting massive checks into the space, right? And so we're seeing really, really great businesses like Amber, for example, which has succeeded massively because they brought that layer of professionalism from Morgan Stanley into the space. I'm a former Goldman guy myself, so most of GSR is Goldman as well. So I think there's a lot of talent and capital that's flowing into the space, building the rails that allow for the next $1 trillion+ to flow into the space. And I think one of the coolest things that I've observed is that there's a typical life cycle, like Michael talked about, in terms of adoption of crypto. So first you learn about inflation. You're like, wow, the Fed's printing so much money. What happens to my dollars? Then you learn about Bitcoin. Then you learn about Ethereum. And you're like, wait a minute, Ethereum's really cool. You download MetaMask, you play around in DeFi. And where we play in is basically once you go into DeFi on ETH, you're like, wait a minute, I don't want to spend $100 to move my own money from one wallet to another. Then they learn about Polygon. They're like, wait, it's less than a fraction of a penny. Let me do that. So we've seen a massive explosion mainly because of that adoption curve. And I think that adoption curve is only going to accelerate as news goes out and people are like, whoa, I can get steady 8-10% yield on my USDC, like in a very safe platform. Like that's much better than the 50 bips or whatever I'm getting in traditional savings accounts. So I'm very excited to be at the forefront of this adoption and the collision of the world that Michael and I come from, and also the world that we currently love and are filled with really cool crypto degens. So I'm excited for it.
Yeah, same here. I'm also really excited. I can basically say +1 to everything Dean just said. We also enjoy a lot to work with companies like Amber, for example. They are very also professional, making markets on many important markets. So that is good. And this is also very important for the institutions we talk to. Everyone basically wants to look at very liquid markets. This is where for example, Amber helps a lot. Everyone wants very fast and cheap transactions. This is where like Polygon or Celo, the whole communities that are behind these projects focus on, to provide basically scalable and cheap transactions on the blockchains. So I think this is very important. And then also basically all the other infrastructure like custody also has improved significantly over the past years. For institutional buyers, you need a professional custodian as well, where you can basically also insure your assets. You can hold your assets safe. I mean, when you talk to the first ones who invested like big time in the space from an institutional perspective, they didn't feel good to walk at home with a ledger in their pocket and having to carry around all this stuff. So it's good that also here this the whole ecosystem is improving. So yeah, plus one to these points you've mentioned.
Yeah, so when it comes to active management and institutions actually buying in, like even last week I had a call with a top 10 bank whose fund of fund department is looking to allocate to crypto asset funds, because essentially a lot of these banks themselves, they don't have approvals yet to trade it themselves, but they're getting approvals to allocate to funds, right? And all the questions, essentially, none of the questions revolved around strategy or anything. Pretty much all the questions revolved around custody, operational security, and so forth. And I think two things need to be said. One, we've come a really long way. Where when I first set up the fund, back early 2018, there's like 3 auditors that would work with crypto funds, and then 2 of them, or like one of them, said, "We will only work with you if you use a custodian." So then I was like, what's a custodian out there for crypto? And pretty much, I think at the time it was only Kingdom Trust, right? So there was like one single custodian, and what would they custody? Pretty much Bitcoin, right? So like nothing else. So like as little as like 3-4 years ago, you had more or less like a single custodian doing a single asset. Today you've got a handful of custodians that have proper licenses, the SOC1s and SOC2s, and that have multi-assets. And now we're getting even further, and this is the key part for active management, is that now that DeFi is playing such a big role, can you do more than just holding, right? So you have platforms like, Fireblocks, MetaMask Institutional, Copper, and so forth, all these toolings that allow you to still maintain good operational security while engaging with yield farming, while engaging with AMMs, and so forth.
Mm-hmm. Yeah, I mean, you guys nicely dovetailed into, this next big question by already touching on some of the challenges, right, that the institutional crowd, has been facing. Earlier this year, just in March, there was a JP Morgan survey that was done, covering 3,400 institutional investors from over 1,500 institutions, that showed that a majority of them do not plan to invest in crypto or trade in crypto, right? And, the guys here obviously can think, massive opportunity loss. We've been having a lot of fun here, making this space better for these guys, right? But one question that I would love for each of you to kind of dig deep into is, what are some recurring questions that you get when you're speaking with the institutional crowd? Right? Questions that you're like, wow, I really should be writing an FAQ because I'm getting them so often. So Felix, maybe we can start with you here, since you run an active fund, active management fund. What are some of these questions that you're getting and having to deal with?
Yeah, 100%. And I would say, that survey can sound like it's a negative thing, that 78, I think it was like 70% are unlikely to allocate to crypto assets. What we got to keep in mind is that back in 2018, 2019, there was a survey by another company. It might have been like PricewaterhouseCoopers, but there was the same survey being done every single year. And I think 2018 was like 6%, and then 2018 was like 8%. And we celebrated that 2% increase. We were like, wow, like that number has grown by like 33%, because if you do 8 divided by 6, like 30% growth, yay. If you do 100 minus 78, that's 22. That's actually quite a lot of institutional folks that think it's possible or likely that they invest into digital assets. And then on top, I think in the survey it said 56% think that crypto is here to stay, right? So that's very bullish, actually. And so I think that word unlikely is really more rooted in the infrastructure, where they need approvals because there's a lot of red tape. And I think there's a lot of like, we called it CYB, cover your butt, where it says like, it's a high risk asset class. Do I really want to be the first guy allocating to it? But it becomes more normalized. So really, we call it like the institutionalization of crypto funds, where, the things they're asking for is like, better reporting practices. Right now, it still takes most crypto funds, I think it's T plus 45 days, which means after the month is over, it takes 45 days to even figure out what NAV was, what the net asset value was, right? 45 days, which means the month of October ends, investors will not find out till, let's say, mid-December what the investment was worth end of October. Why? Because it's so complex, because it's a very manual, meaning there aren't really great tools yet where at any given point in time, all this stuff, right? Most crypto funds, even like the ones worth billions, run internal spreadsheets, right? Because we don't have this great institutional tooling yet where you can see it all at once, right? Even normal users use platforms like Serion and Zapper, but if they're missing, 1 or 2 or 3 or 4 integrations, all of a sudden the number's completely off, right? So I think institutional folks want to see, better reporting, faster reporting. Ultimately, it should be real time, like we're used to, from traditional finance. Custody, as we already talked at length about, right? Custody, operational security. And I think overall, they just want to see these crypto vehicles become more and more resembling of traditional vehicles, because ultimately, we're no longer dealing with, 7-figure funds. We're now dealing with like some of them, literally billions or tens of billions, where it's just no longer acceptable to have, degen infrastructure, to put it simply.
Yeah, Markus or Dean?
I mean, for me, when I talk to traditional investors, to institutionals, like typically the first questions I get as an economist is basically, what is the real economic value added when I invest in all of these things? And some of the institutional investors always had a very hard time to understand, for example, what is the value add of all the DeFi things, if it's currently more used for example, speculation, but less used for, loans that are financing small and medium businesses, or for transferring basically either liquidity or transferring maturity in any way, which is basically the economic value add of like the traditional lending and borrowing space. And it takes, I think, a bit longer to explain this to traditional investors. And the good thing is that we now actually see that basically this is more approachable for also end users. When Cello launched its DeFi initiative, it was called DeFi for the People, because it also has a focus on providing basically cheap DeFi opportunities that actually also, real users that maybe are not just in that game to speculate, can use this, but also to use this to fund interesting ideas, to fund new businesses, and all these things. So I think if we are as an industry and as a group of people working on this, able to show traditionals that where the value add is in an economic sense, I think then it's easier to get the people into the space. And this is not always easy because, of course, they're used to different kinds of markets. But yeah, I think we're getting there.
Yeah, I think we also have to be cognizant of kind of positioning and optics, because if you're a really successful fund manager or something, I don't know any successful fund manager before they put a big investment in, they're like, oh, I'm buying this thing, right? And letting other people front run them. So like, if you think about it, it's not in JP Morgan's interest to say like crypto is amazing, everyone's adopting, because either they haven't put the visions in themselves, or the products that Felix or other fund managers in crypto are offering significantly better returns relative to the risk that JP Morgan currently has access to, right? So obviously it's not in their best interest to say that. And I think just from a pure like insider perspective, so recently we launched the Osprey and Bitwise funds, right? So like Felix and Michael were talking about, we need some really big name guys to social proof certain asset classes. So that's, for example, Michael Saylor, right? When he went out and a couple of other people jumped in, Guggenheim, et cetera, it suddenly became acceptable to hold Bitcoin to some degree, right? So it wasn't a major career risk anymore. If you're a fund manager and you put Bitcoin on the balance sheet, like you could say like, hey, Michael Saylor did it, this guy did it, and like if it comes down, like you don't necessarily get fired. Whereas if you're the first guy, it's very easy to get fired because you're like, what the heck, no one else did it. That's one thing. The other thing is recently after these vehicle launches and people went on CNBC, Bloomberg, whatever, talked about Polygon suddenly became acceptable, right, amongst the community. Obviously, nobody's going to say that in a poll, but we had market makers, the head of trading of a major market maker called me, basically like, dude, I need an emergency Matic loan because we're actually short because our hedge fund clients are buying up a ton of this. And the thing is, these hedge funds would never go out there and say like, I'm buying this, right? But the thing is like they are, and you can see this in the price action this past week. And so like we have to be very cognizant about like what people say and broadcast in mainstream media and what they're actually doing. If you look at the on-chain metrics, it's very clear like where the funds are flowing, where they're coming in from, and the adoption is just going to accelerate as people realize that the returns are here and there's a lot of technology that's going to eat up traditional finance as we know it.
Yeah, totally agree with what Dean, Markus, and Felix pointed out in terms of what the guys might say versus what they might actually do. Anecdotally, I can kind of give a interesting evolution of the kind of questions we receive from our more traditional institutional customers. By the way, I'll get back to that point. I think, right now there's an interesting trend of, when we define institutions, we more and more cannot overlook the new type of crypto native institutions, such as, the fund Ding is running for Polygon, or C-Lab that's running by Markus, or Felix fund. I think they are playing as important role as the more traditional institutions in the space. But back to those, TradFi guys, right? I think a clear trend we've seen over the past few years, back to your question, is the type of question they asked went from why do I need to invest in crypto? Give me a reason. Why do I even care about this asset class? To how, what's needed, right? What's the infrastructure that's there? How do I actually do it through Amber or through whoever? Right now, the question is most commonly what and when. What assets do I need to buy? Now I have Bitcoin. Should I look into Ethereum? What are the Ethereum competitions? What are other chains? Should I buy some Polygon? Should I buy some Celo? Right? The question become what, or even sometimes when. People start to look at timing. What are the right strategies? People start to talk about trends with us. Talk about market theme rotation. All the same stuff you have with your stockbroker or with your prime broker as a macro guy, right? So the trend is pretty clear. Now going back to the previous point I brought up, right? And I think a big reason why this conversation evolved, why the guys felt they needed a reason to be involved. Now they are already involved. They want to be involved more, and they can no longer wait on the sideline. Is the rise of these crypto native institutions. Look at some of the largest investors globally, right? And they are all deeply in crypto, right? Look at some of the very large crypto native investors, right? A lot of the very successful protocols, their investment are managing billions of assets, right? Like such as what Ding and Markus are doing for their respective projects, right? And you have crypto native investors, the likes of Paradigm, Pantera, they're managing billions and billions of dollars. You have firms like Amber, who is not only managing billions of dollars, through us actually, a lot of our traditional sort of customers are connecting and interacting with the crypto native players. So if you are a traditional fund manager, now the pressure is, if you don't give the access to the products, the yields, your crypto native peers are providing, your investors are going to leave you for these crypto native investors. So, that is a real career risk now. Now the career risk is no longer, hey, if I damper in Bitcoin, I might get some returns, but I might lose my job. Now it's about, okay, we might have a huge fund outflow if we don't have this exposure, because that's what our LPs, our customers, our investors are asking about every day.
Yeah, such great points from all of you guys. Michael, just to pick up on one point that you mentioned there was market theme rotations, right? And some big trends that we've seen over the past year or so, or for DeFi, it's 2 years now, but are decentralized finance and NFTs, right? But this is no longer just the so-called really small crypto degen, kind of like focus ecosystems anymore. Now we are starting to see not only protocols building for institutional capital, but we're seeing this genuine institutional interest to understand why it is that they can get higher yields in DeFi versus, for example, in the centralized finance space, or because of that, why is it the case, right? And trying to understand the market structure. So, Dean, how or what is the level of institutional interest in DeFi and in stuff like NFTs now? What are you hearing?
Yeah, so not just what I'm hearing, I mean what we're seeing. So Clinique, separate from us, which is like a multi-billion-dollar cosmetic brand, they chose Polygon as the chain they're going to launch their NFTs on. And I actually feel a little bad because I should have been there to give them like the best service and be like, hey, how do we onboard you? They literally just announced it on their own, like separate from us. I was like, that's amazing. So like,
oh, wow.
Yeah, so like that happened I think yesterday, and then we have like it's just so many crazy things are happening because people are realizing that you don't really need the middleman anymore. And like NFTs, like as much as craziness there is with it, there's a lot of real world applications that allow you to own the content you create, right? So I had a meeting with a major Hollywood executive for during Money 2020, and he was talking about like all these major stars that want to own their own stuff, right? Right now they're kind of on Web 2, whether it's Instagram, YouTube, etc. The next wave is basically they're going to own all of it, right? And the NFT is going to give you exclusive access to certain events, certain meet and greets, etc. And there's so many applications, whether it's for artists, musicians, movies. On the NFT front, gaming, we have $100 million a Polygon Studio fund that's targeting just for gaming, which is a whole nother thing in terms of Metaverse and stuff like that. But overall, I think just like we did a partnership with DraftKings, right? That we're going to be basically the rails they're going to use for their marketplace. So it's all of these major players that are currently in the Web 2 world, they're recognizing and preemptively coming to us and being like, hey, how do we get in this game? How do we build the infrastructure around everything so that we can not get left in the dust in terms of, being, maybe some 1999 internet company that went bust, right? So they're very aware of this and they're approaching us or doing things separately. We did a Dolce & Gabbana launch as well for NFT campaign. So it's incredible, and we're very blessed, and I think it's the coolest thing in the world because you're just having this intersection of everything, whether it's athletes, actors, musicians, like everything is colliding because we are the rails for this new Web3 world.
And maybe to add a bit on the NFT story, I mean, of course, we also saw that basically the whole creative space, went into the NFT direction, and this brought a lot of like hype and wonderful ideas to these kinds of tokens. But actually, I would say, especially in institutional adoption, we will see even more in future. I think we not only see the creative ideas as NFTs, we will see also insurance contracts being NFTs, or owning an apartment could be represented as an NFT. A next big topic for me that also is related to NFTs is the whole sustainable finance area, where you could imagine trees being tokenized, something we also now look a lot into it, and something that also is super interesting for institutional investors. You could imagine a triple green bond living on Celo. For example, Celo as a blockchain is already very efficient and carbon negative, but it could also be an NFT that is a bond that invests in something green, where the coupon payment is a smart contract based coupon payment that is linked to the fulfillment of certain green goals. You could imagine even many more interesting things. As I said, trees as NFTs, and trees could then be used as collateral for currencies. And we would create nature-backed currencies. All topics that are finding a lot of interest in the institutional world. Because they also know they have to look into this, therefore I would say it's great to see what is happening in the NFT space, and I really expect this is just the beginning.
Yeah, and if I can just say one more thing, I think it's actually the combination of DeFi and NFTs that is causing this new wave of the metaverse, and why you're seeing metaverse more and more is because with the metaverse, the way if people ask what is metaverse, to me, it's a digital first world, right? The internet is an auxiliary tool that we use to engage with the physical world, but the metaverse is a digital first world, and this is possible for the first time in human history. Why? Because we have digital first financial markets with DeFi. You can spin up an entire financial system already now using the existing tools. You have digital first goods and commodities with NFTs, for example, right? Like you can create completely digital goods and prove their scarcity and authenticity. Never been possible before, right? You have digital first governance structures. You can spin up a DAO, a decentralized autonomous organization, and let this new virtual world like govern itself. I think the metaverse is this culmination of multiple different innovations that have happened at the same time, from DAOs to DeFi to NFTs, combined with a continued improvement in virtual reality and augmented reality, where all of a sudden it's more immersive, and it's just kind of the perfect storm where all of a sudden you see something, bloom that just wasn't possible before.
Totally. I mean, to echo what the panelists said, right? I mean, there are a lot of new inventions that are only enabled by the broadly defined crypto finance technology, be it DeFi, be it NFT, right? And I think one thing that's really happening is it's becoming more and more relevant to everyone, to every consumer, to the average consumer, to the mass market, right? I think DeFi, because of the whole buzz, right, the whole yield generation, really sort of created this enough incentive for a lot of people to be educated through the whole decentralized experience, right? Before that, DeFi was already there, but it's a very niche thing. The hardcore users love it, but the whole experience wasn't that easy for first timers, right? And because of the boom of yields, and similarly, what happened with the NFT as well. You have popular celebrities, athletes, bringing their followers into the ecosystem. Now, a lot of people are more or less educated about DeFi, about NFTs, then they are then in turn educating their friends, family, people around them, right? So you're creating this larger and larger community, and therefore, a much larger base to really apply all these innovations we just talked about, right? And for example, what Markus just discussed, sort of a NFT enabled social responsibility efforts, right? And both for corporates, for companies, I think that's almost an inevitable trend, right? Take Amber Group as an example. We just announced, a recent collaboration we did with Moss, where, we bought 2 million of carbon credits and tokenized them, right? And, this can be relevant for the individual as well. A lot of our users are gonna start owning them through the Amber platform. They're gonna start to contribute to protecting our planet, while at the same time the amazing thing is they might even earn a very amazing return from that at the same time. Similar things are happening, for example, with personal credit, right? Personal credit, personal behavior, and all the user generated data are being tokenized into assets. And once they're assets, right, they can be used as collateral for lending. They can be used as peer-to-peer payment or transferring of assets, right? So a lot of these innovations, they will start with a small core community that really understand the backend technology, very developer heavy or product heavy, that sort of create these, right? But through platforms like Amber Group, or through the Polygon network, the Celo network, right? They're gonna be passed on to the end consumer. And I cannot emphasize how important that is, because the least thing I want, right, after 4 or 5 years in crypto, is crypto to remain this cool thing among a bunch of really crypto maximalists. I think that's way unselling the potential of the technology. For crypto to really be relevant to the whole world or to the mass market. I think we are finally going through that first stage of sort of creation to the second stage of passing on to the power and the benefits to a much bigger audience.
So many powerful statements made just there. I wish we can go on for another hour, seriously. But to wrap up this conversation, because I know we're a little bit over time, would love for you guys to say one word, or max 2 or 3, that you think represents a trend around the theme of institutional adoption that you think will be playing out in 2022. So just a couple words there. Maybe Dean, we can start with you. Then we'll go Markus. Yep.
So just to reiterate, the one word that captures the trend that we'll see for institutional trends. I wrote a Twitter tweet the other day about this. I think so the one word would be aping. And what I mean by that is, obviously, aping is among DGens is very popular, but I think institutions are no different, right? Don't be fooled by the suits and the pedigree. Like, when institutional aping happens, it's going to be the biggest and strongest ape we're going to ever see in our space. And the question is, which coins and which projects are they going to ape into, and which one's going to absorb most of it? But aping would be my word.
For me, it's maybe 3 words, but I write them together as one word, which would be natural capital assets on blockchain. I really love the idea, for example, of the tokenized carbon credit that Michael just described by Moss, and I really hope that the technology in the next year actually allows us to, for example, internalize the cost of like carbon emissions. It allows us to build something really sustainable for the future. So I hope that the industry and also institutional adoption is also going that way. So that would be really cool.
For me, it's greed. Actually, so similar to Dean, back in 2018 or 2019, I actually made a thesis that, if 2017 was the cycle of retail greed, where, ICO mania went over everybody's heads and we went crazy, I would say this cycle will be the cycle of institutional greed, because there's a lot of people out there, the asset managers who look at people like Paul Tudor Jones that probably had an incredible 2020, probably an even better 2021 because they allocated Bitcoin. CEOs look at people like Michael Saylor, who essentially, I think, 6x'd his market cap by buying Bitcoin, right? And as some of these are now getting more and more approvals, I think we will see this wave happening as early as the beginning of 2022. That now that they get approvals, they will want to make up for missed time. And as they see more success, that will be a self-confirming loop, so to say, with like, see, I'm smart, I did well, and this pushes it higher and higher and higher. So I would almost expect like an institutional trade 2017 mania, if that might happen, yeah.
The one word for me as regard to institutional trend into crypto, I think is integration. I think at this point, institutions will have no choice but to actually integrate with the crypto ecosystem. They will have to integrate with the existing tech stack, whether by themselves or through through platforms such as Embers. Or at the same time, they will have to integrate into the DeFi ecosystem, into the NFT enabled Metaverse and all of that. And I think that integration is healthy, because in the end of the day, what defines institutions? Institutions are essentially organizations or people, hopefully professionals, managing other people's money, right? So they do have this responsibility to not miss out on the future, to not miss out on probably the fastest growing areas of technology. And it's probably too hard for them to start from the scratch, because you have guys like on this panel that have put in years of work and formed a very crypto native expertise around it. So I think for the traditional guys, for the broader institutional guys, they will have to the easiest path is probably to integrate with the existing ecosystem.
Great. So we have aping, natural capital assets, greed, and integration. With that, thank you all to the panelists for your time today, and thanks for our viewers as well for spending some time with us today. Have a great weekend, everyone. Happy Halloween.
Thanks, everyone.
Happy Halloween. Thanks,
Happy
everyone.
Halloween.